you talk about market participants who've failed to realize a regime shift in the current environment. The friction between central banks and markets, where does that leave the second half of the year?
Well, I think we're basically going into a new regime in terms of the next quarter, not a year possibly, potentially even more than that, given the fact that basically we don't have a clear view from the central banks where inflation tapers out. What we saw in the last FOMC meeting, especially Jay Powell and Madame Lagarde speaking, is that they don't know the effects that the Ukraine-Russian conflict will have on inflation down the line. This is really the big crux here. In many ways, central banks were prepared for tapering of inflation given COVID and the re-engagement of the economy, but the Ukraine-Russia war actually threw in a whole new dimension, which is structural inflation out of energy and food. So we have a whole new dimension right now, and in terms of their pace, the central banks now have to catch up to inflation. So they're not only behind the cycle, they're behind the cycle in a magnitude which is perhaps much greater than they anticipated.
Well, that behind the cycle has got ramifications for an unanchoring of inflation, according to Bullard, and that is the risk. Saed, we put it into the GTV library. This is the Michigan inflation expectations, and if you look out at the 5 to 10 year part of the curve, that's where the agitation comes. This is where Powell stated it was eye-catching. In your view, this paradigm shift, does it involve a repricing of inflation expectations? If you look at this chart, the market is way ahead here. Does this endure?
Well, once again, I think we're looking at a situation where the Fed has to reprice to a neutral rate. So we're perhaps moving from 3% circa up to 4.5% in the medium term. So I'm expecting the Fed to be a bit more hawkish. You saw that Powell managed something magnificent last week when he actually came out raising 75 basis points and sounded dovish at the same time. In fact, Powell should sound more hawkish, but again, the Fed's trying to play two things at the same time. On one side, they're trying to play alleviate the stress on asset prices and equity markets, and at the same time trying to move monetary policy to match inflation. So it's a balancing act in many ways. On one side, he has to sound a bit dovish to allay the risk, but down the line, there's really no change. The Fed will have to increase their rates. That will pressure corporate earnings. That will pressure pricing in the S&P and Nasdaq. We'll see a global change in terms of equity pricing lower.
I mean, the Fed might have bold goals, but then there is a market reality even beyond equities. I'm looking at real estate, where prices could come under pressure very soon. I look at what mortgage rates are. A new report out by Capital Economics suggests that Americans now have to pay more than a quarter of their annual income towards mortgage payments. That surpasses the average 24% that we saw in the mid-2000s. Is this going to be potentially the next area where we could see quite a bit of pain?
Well, I think one thing you have to look at is basically real estate investment trusts. You've seen basically a rise in rentals across the U.S. and globally. In fact, that's a reflection of inflation. We only see a situation where basically investment in real estate takes a backseat, especially in a world where basically you have rising rates. So repricing in terms of remortgaging and finance and real estate will have to take a backseat now towards more real economy in terms of rentals and the impact of inflation relative to income. So we have a situation right now we have inflation driven by structural issues relative to income. It's not a growth-led inflation. This is more structural. So this is going to have a much deeper impact in terms of the real economy than previously seen.
Well, that's certainly what Christine Lagarde was leaning into yesterday evening. She talked about average wage levels, tighter labour markets, and that is going to play through. So the market's pricing in 175 basis points from the ECB this year. I'm just looking at the screen here. So this is in the GTV library. Do you think, listening to Lagarde, your big parity call is just dead in the water on euro, and that she will be a lady not for turning?
Well, one of the things in terms of just the euro currency or parity call, if you have it, is basically right now you have a situation where everything is relatively poor. Dollar is poor, euro is poor, yen is poor, Swiss franc is poor, sterling is poor. But in terms of when you look at monetary policy and who's actually being more proactive, it's effectively really the Fed. The Fed has a lot more in terms of ammunition, in terms of tapering off inflation than the ECB. The ECB has a different issue in terms of their locality. Europe has a great deal more exposure to inflation, structural inflation out of Russia, oil and food out of Ukraine. So ultimately, Europe stands to have a much harder time in the short term relative to the U.S. simply because the Fed monetary policy is much more ahead. So what you see now is, we were talking about December, ECB moving in October, November, December, that period. Now you're seeing the ECB trying to catch up in terms of hiking. So we expect now the first movement from the ECB to be the next meeting next month. So there's definitely a repricing in terms of the curve, but will the ECB be able to move fast enough? I have a very hard time believing that, given the handicap the ECB has, especially in regards to peripheral spreads, they'll be able to move fast enough relative to the Fed.